What's up, everybody? Nate here. And obviously we know in the United States that the housing market is at a turning point. Some markets might see a price decrease of around 10, 20, and 30% over the next year and a half, and mortgage demand has dropped to a near 25-year low because houses are extremely unaffordable right now. But this housing problem that we're seeing in the United States isn't exactly unique to this country. That's because other countries throughout the world and some major players on the global stage like China and Great Britain are also having their own housing market issues. In Great Britain right now, there is a growing sentiment that the housing market throughout the entire country could ultimately collapse because of tax cuts and homes being completely unaffordable for most people. Not only that, but we're starting to see in Hong Kong, mortgage interest rates start to rise and the prices could potentially go down. Goldman Sachs actually predicts that the prices in Hong Kong, the world's most expensive housing market, could actually crash by around 30% within the next year.
Okay, that's not good.
And all of this has to do with, you guessed it, the Federal Reserve. Now, the Federal Reserve and the monetary policy that they set in the United States absolutely does matter, and it matters not only for us and for the markets, but it matters from a global perspective. And today I want to talk about what exactly is going on with the global housing market all throughout the planet. I want to talk about why China and Great Britain are starting to have a really big housing market problem, and I also want to discuss what exactly is going on here in the United States with our own housing market, and of course what the Federal Reserve has to do with all of this. Alright, so let's talk about the UK and the Bank of England. Now, the first thing you've got to understand is that the mortgage process over in England is completely different than how it works here in the United States. In the US, it's not uncommon to get a 30-year fixed mortgage. This means that the interest rate for your mortgage is going to be the exact same from day one to the 30-year mark. It's not going to change for the entirety of that loan. This ultimately saves people money, and it can help with volatility because you know that your mortgage payments are going to be the exact same every single month. However, in Britain, it is a little bit different. Their mortgages range a lot shorter, so they actually have short-term loans of around 2 to 5 years. A lot of the times those interest rates are fixed, so when we talk about a housing crash in Great Britain, everything that's going on today is going to affect them a whole lot sooner because their interest rates and their mortgage terms are shorter. And according to Oxford Economics, the housing market in Great Britain is 30% overvalued, so people don't have enough money in order to make a new mortgage payment, which means people over in England are not going to be able to afford a new home anytime soon. They don't have the income for it. Now we move over into the Bank of England. Now, the Bank of England has had a huge problem over the last few weeks because they have started to buy up treasury bonds because, well, investors had a massive sell-off because of some tax cuts. A couple weeks ago, Great Britain announced that they were going to have some pretty massive tax cuts, and that meant that the pound was suddenly going to start losing value because that is an inflationary policy. Not only that, but they said they were going to start taking on more debt in order to get themselves out of this economic pickle that they're in right now, which again is highly inflationary. So investors over in Great Britain did not want to hold on to any assets that were tied to the pound. They started to go to other assets and other currencies like the US dollar. So the pound ultimately lost a ton of value, and the entire bond market fell because of that, because those bonds are directly connected to the currency. So Great Britain announced that they were going to start buying the government bonds in order to stimulate the market and keep it afloat, because all of those bonds were connected to pension programs and retirement savings all throughout the country. Now, that is a pretty simple explanation, but I actually made an entire video on this just a few weeks ago, and if you want to watch that in full, the link is right up here in the corner. But the bottom line here is that the bonds are being bought in Great Britain. Now, what exactly does this mean? How exactly does the Bank of England buy these bonds? Well, they have to spend money in order to purchase these bonds. They're pouring money into the market, so that way these investors have some liquidity and they can continue to buy bonds because they believe that it's going to be a little bit of a safer asset to hold right now. But the problem is the implications this has for the future. The Bank of England and the entire United Kingdom has seen some pretty serious rate hikes over the past few months. They have a really bad inflation problem too, just like the United States does. So they have been raising their interest rates aggressively, and now that they're starting to buy even more bonds, the fear is that they're going to have to raise rates even more in order to strengthen their their own currency. They now have an even bigger inflation problem because they're pouring billions of dollars back into the markets. So the only way that the central bank can really fix that is by raising its interest rates and making it harder for investors and people to come across money. And that is where we come into the British housing market. As the central bank starts raising its interest rates aggressively, all of those people that got mortgages 2 years ago when the pandemic really started, and people who are going to be coming up on a new mortgage in 2023 or in 2024 are going to be facing extremely high interest rates. And prices for a home in the UK are out of control. Like I said, 30% overvalued in most markets. What people are worried about is all of these mortgages are going to eventually flip, and they're going to end because Great Britain has a shorter mortgage period, and now people are going to be faced with getting a new mortgage or selling their home. This could ultimately lead to a huge crash in prices. And that obviously has global implications for everything, because now all of these markets that are connected to these bonds, all of these markets that are connected to these mortgages are also going to start losing money. Where have we seen this situation before? Sounds very similar to what happened during the 2007 crash in the United States. Almost exactly the same. But now let's go ahead and switch gears over to the Hong Kong problem. So Goldman Sachs actually believes that the housing market in Hong Kong could go down by around 30% over the next year or so.
Come down hard.
And this all has to do with the Hong Kong interbank rate and the Federal Reserve. What you've got to remember is the US dollar is the reserve currency of the world. So other countries are holding on to US debt because they want US dollars, and businesses are trading in US dollars on the global scale because the US dollar is so strong and it's backed by the United States government and military. So when it gets a whole lot stronger, that affects businesses all across the world, because that means businesses are ultimately going to see a lot less US dollars. And in Hong Kong, they want their currency to be stronger. They want their currency to be really strong compared to the US dollar. So when the Federal Reserve starts raising its interest rates, that means a really strong dollar and less dollars circulating throughout the entire world. It lowers that demand a whole lot. So Hong Kong is actually raising its interest rates in line with the Federal Reserve because it wants its currency to be really strong compared to the US dollar. What that's doing though is sending interest rates for banks and other financial institutions way out of control. And with the housing market already really high in Hong Kong, people are not really able to afford new homes. Basically, if the Hong Kong Central Bank actually lowers its interest rates, well, think about what that means. Now, investors can actually take US dollars to get more Hong Kong currency. So then, in theory, they could go out and get a home, or they can invest in more businesses over in Hong Kong. But that just means that more Hong Kong dollars are going to be out there, and that devalues the currency even more. So they can't have that. They have to keep it strong and in line with the US dollar. In 2021, the average home in Hong Kong was 23 times the average income, and that might continue to go up as demand gets a whole lot smaller, and same with supply. And as these mortgage interest rates go up, nobody is going to be able to afford a home, meaning all of that is going to have to come down. Prices and demand are all going to come down in Hong Kong. To put it in perspective for you, the least affordable housing market in the United States is San Jose, California, and it is 12.6 times the average income in that area. So the Hong Kong market is more than double that. Obviously, the housing market in China has been slowing down for a very long time because of mortgage issues and a lot of mistrust in the banks of China. So now Hong Kong is just becoming the latest victim of all of these housing market crashes. And I've talked about this in other videos before, but the economy of China is also taking a big hit, with manufacturing taking a big hit because demand across the globe for items and other things is going way down. So the entire economy is not making as much money because it relies on those sales. Also, its markets have been going down because of the Federal Reserve and the China's central bank policies. And the real estate market is tied to all of that, with people not paying their mortgages, and this new problem with housing unaffordability means that we could see a big collapse in the real estate sector and other markets markets in China and Hong Kong very soon. Now let's go over to the United States and the Federal Reserve. Now the Federal Reserve has a unique problem because inflation is really high in our economy too. So that means that they have to start raising their interest rates pretty aggressively in order to bring it down and eliminate demand. But as they start to do that, mortgage interest rates go way up in the United States, and that is part of the reason why mortgage demand has recently hit a 25-year low. This gives the entire market time to kind of catch up to what demand should be in our entire housing market. Supply means that more houses are going to come on the market because there's fewer people trying to buy homes because people can't afford many of the homes that are on the market right now. But we are starting to see prices in just about every market go down in the United States. Maybe not drastically and maybe not every single market, but most markets are seeing a price decrease. Now, depending on how low those prices go will depend on how high the Federal Reserve raises its interest rates. It is expected to raise interest rates again by around 50 basis points or 75 basis points in its next meeting in November. That'll put the federal funds rate at around 3.75% to 4% in the US, and it could send mortgage interest rates well into the 7 and 8% territory. That is almost triple what they were just a year ago. Not to mention the housing market typically does slow down in the wintertime as fewer people are looking for homes. It's a lot easier to move in the summer when it's warm and everything is clear than it is in the winter when it's cold and there's snow everywhere. And the vast majority of people live in the central or eastern part of the United States, meaning that it's going to get pretty cold here pretty soon. But as the Federal Reserve raises its interest rates, that could mean a really big problem for not only the United States, but for the entire rest of the world. Like I said, this means that the US dollar is going to get stronger. It's going to be harder to come by US dollars. You can't just go out and get a mortgage very easily, and you can't get an auto loan, and you can't spend on a credit card because all of those interest rates are going way up. So it's harder to come across US dollars, making your currency a lot stronger. And when you have the reserve currency of the world, that is a big deal. But it also means that investors are not going to be able to take on debt as easily as they could before. So they're not going to be able to buy real estate as they were in 2020 and in 2021. And they're not going to be able to invest in businesses. So businesses cannot grow as quickly. And because consumers are not spending as much because of things like inflation, that means all of these companies and corporations are going to have to figure out ways to cut costs, and that usually involves people. And if people aren't able to afford their mortgages anymore, well, now prices come down even more. Some estimates are saying that we could see the housing market in the United States actually drop between 10 and 20% over the next year and a half. And that would basically eliminate most of the gains that most markets actually saw over the last 2 years or so, which means some homeowners are going to become underwater on their mortgage, so they can't sell and they're basically stuck with a house. And if they do sell, they're not going to be able to cover that mortgage. So they're probably not going to want to sell their home. They're going to want to stick it out if they're currently employed. And that's really what this all hinges on in the United States. If people are still employed and they're keeping up with inflation in their paychecks, well, then they're going to be able to pay their housing payment. But if we start to see mass unemployment and inflation continuing to go up anyway, well, that could mean that now the housing market starts to collapse. Nobody is able to afford their mortgage anymore. Nobody's able to get in on a new home because everything is way too expensive. How does this all play out on a global level? Well, the housing market is something that is supposed to be pretty stable in every single country, but with prices going way up, that means more and more Americans and people abroad are going to be spending more of their paychecks on housing. If they go into foreclosure, that is an even bigger issue for everyone, like the mortgage-backed security market, credit default swaps, and Americans having even less credit to be able to go out and get a home in the future. At the end of the day, Americans have to live somewhere, so if they can't afford a house, then they're going to have to go to an apartment. But apartments and rentals all throughout the United States and across the world have also jumped in price because of demand going up too. And if you mix that with a lack of income because of unemployment and really high mortgage interest rates while the Federal Reserve battles inflation, now you have a situation where pretty much nobody is going to be able to buy a house. Doesn't matter how many houses are on the market, nobody wants one, which means prices are going to come down. If a crash actually happens, then that could be a systematic failure of many different housing markets and other markets throughout throughout the entire planet, which means there is a lot of money lost all at the same time. But now I want to hear from you on this issue. What do you think about the global housing market? Do you think the housing market across the planet is going to collapse sometime soon? Or do you think that everything is going to work out and the housing market is strong because the jobs market is strong and the US dollar is strong? Whatever your thoughts are, leave a comment below before you go. But that is it for today's business and financial news breakdown. Thank you so much for watching. If you want to stay up to date with all the top business and financial news from around the country, our team puts together a free daily newsletter, and you can subscribe to it by clicking the link in this corner right here. And if you want to stay up to date with me and everything else happening in the business and financial world, I'm putting out updates 7 days a week over here on this channel. I've actually got another one ready for you right here, so be sure to check that out before you go. That is it for me, everybody. Be kind out there, and I'll see you all in the next one.